So the topic of the video is obviously financial modeling interview questions, and we're going to be looking at top 5 questions which as a candidate for applying for various financial modeling jobs you should be focusing. So let's look at the first question, that is what is DCF and what is terminal value, right? Now DCF is discounted cash flow, and what exactly we are trying to do is we're trying to forecast the company's future cash flow and we're trying to bring it back to the present, right? And that's what is DCF. But that is only for the 3 years or 4 years of forecasting that we're doing. The rest of the company, which basically the company is a going concern. So if you're able to forecast the companies for 3 years, doesn't mean that the company stopped operating at 3. The company is a going concern, so it will be there forever. So the value that we associate for expectations in the future is what is terminal value. Both of these, when they combine, you get what is the valuation of a company. Second question is, how do you analyze trade receivables? Before answering this question, you need to understand first what is trade receivables. Trade receivables is when you are selling a product but not exactly getting the cash at the same moment, and that is usual with every company, right? But the important thing what you should be considering is how much of that is a part of the revenue, right? If a company has 80% of its revenue in receivables, is not a very good sign. Right. So when you are analyzing receivables, the main part that any analyst should be looking at is what is the average duration of collecting the receivables, whether it is 20 days, 30 days, 60 days, or it is 1 year, or is it more than 1 year. So the higher the number of days to collect the receivables, the lower is the cash flow, and finally it affects the valuation. Third question is what is on to price value, and this is a very common question specifically related to valuation, is to understand first the formula of on to price value. On to price value is the market value of the company, which is the equity value, plus debt minus cash. Now why do we even have a formula of on to price value is because when we are acquiring a company, we are not really paying only for the equity. We are also taking the debt, and we reduce the cash from the acquisition price and we take over the entire company. A company A is acquiring company B, right? The value that is presented or the value that is paid is the on to price value and not just the market capitalization. Fourth question is the first question. The example that I had shown you is the linkages between 3 financial statements. Now, one of the most important yet the least answered question is your understanding of how income statement, balance sheet and cash flow are linked, right? And believe me, as simple as this question might sound, it is one of the questions which frequently candidates are not able to answer, right? First of all, understand that income statement is based on accrual accounting, balance sheet is also based on accrual accounting, but cash flow is the reconciliation statement which combines these 2 statements and gets the exact cash flow generated for the business, right? So for example, now let's say you've got something like revenue. Now your revenue is an income statement irrespective of whether you have collected cash or not, because as per accrual accounting, you record revenue when the product is given or the service is rendered, not exactly when the cash is received. So now how is revenue linked to the balance sheet? So there's something called as accounts receivable in the balance sheet, and if the revenue is not collected in cash, accounts receivable gets collected in the balance sheet. Similarly, let's say if you're talking about cost of goods sold, the amount of payments that we are incurring to create that product, right? So now it's not necessary that all the cost related to a product has been incurred in cash. It might so happen that I might be paying my let's say the suppliers at a later date. If that happens, then accounts payable gets created, right? Finally, if we come to the bottom line of the income statement, which is net income, where does this flow? It flows into the equity part in the form of retained earnings, right? Now, if it has flowed into the retained earnings, now the question would be how much company has generated cash in its operating activity. So finally, in the cash flow statement, if you look at the format, we start with net income, we add depreciation, we do changes in accounts receivable, changes in accounts payable, and then we get cash flow from operations. So that's a very common simplistic answer. Of course, you can prepare more detailed answer. It's not obviously part of this video for me to explain you how these 3 statements are made, for which you can check out our another video, detailed video, in which we have covered this properly in detail. The last question related to financial modeling interview questions is what is the approach when you're analyzing a company, right? Believe me, this is one of the questions which is comprehensive, yet it does not really have one set of answer that you can give, and this will show whether you have depth in your understanding of financial modeling, right? So when you are approaching or analyzing a company, you have to remember that when first we need to understand the business, what is the business about, what are its revenue matrix, P into Q, price into quantity. For example, if we talk about, let's say, an IT business, the P into Q would be price is the billing rate per hour and the number of hours that the IT developers are putting in, right? And that's exactly what is the revenue model of a company in, let's say, an IT sector, right? Similarly, once you understand the revenue drivers, the second would be understanding, let's say, in which sector is it operating. Is the sector a mature sector? Is it not a mature sector? What are the various ratios that you would be using for companies in that sector? For example, if it's an IT company, we know that a company is cash rich and there's a lot of expenses which are not very capital intensive, right? And finally, when we're looking at valuation, we need to understand that whether the company that you're analyzing is normal IT matured stage company or is it in a new space of AI, coming up with some innovative products. In that case, I am able to understand whether the long-term growth rate that I have to take has to be lower, has to be higher, or has to be on an average, right? And then finally, looking at the various corporate due diligence that every analyst has to do for every company, right? Because all of the numbers which are presented to you are finally presented to you by the company, and if the corporate governance of a company is not great, then I will not be confident about the numbers itself. So these are top 5 interview questions related to financial modeling, and if you have any questions, please do put it in the comment box. I'll be happy to answer, and I'll see you again in another video. Bye-bye.